What if one of the biggest companies in America was secretly a complete illusion? A company worth over $70 billion, gone in months. Employees lost their jobs. Investors lost billions. And it all happened because of something most people don't understand: accounting tricks. This is the story of Enron and how it became one of the biggest corporate collapses in history. Enron started as a boring energy company: pipelines, gas, infrastructure. But in the 1990s, it transformed into something else entirely: an energy trading powerhouse. Think of it like this. Instead of just selling energy, Enron became a middleman, buying and selling contracts, betting on future prices, kind of like a Wall Street trading firm, but for electricity and energy. And investors loved it. At the center were two key figures: Kenneth Lay, the founder, polished, connected, and trusted, and Jeffrey Skilling, the CEO, the genius behind Enron's strategy. Together, they convinced the world that Enron wasn't just an energy company. It was the future of business. Here's where things get interesting. Enron used something called Mark II market accounting. Instead of recording profits when they actually made money, they recorded profits the moment a deal was signed, even if the cash wouldn't come in for years. So if Enron signed a 10-year contract, they could book all the expected profit immediately. On paper, profits exploded. In reality, the cash often didn't exist. Eventually, the real business wasn't making enough money to match the numbers. So Enron needed a way to hide losses. Their solution: off-the-books partnerships. Basically, Enron created separate companies that technically weren't part of Enron. Then they moved debt into those entities. So on Enron's financial statements, everything looked clean. But in reality, the debt was still there, just hidden. This is the shocking part. Enron was audited by one of the biggest accounting firms in the world, Anderson. Analysts praised the company. Executives were seen as visionaries, and the stock kept rising. So people stopped asking questions. It's the same trap. If everyone believes it, it must be real. But behind the scenes, things were falling apart. In 2001, the truth started leaking out. Reports questioned Enron's accounting. Investors got nervous. The stock began to fall. Then fast. Then faster. Within months, Enron went from over $90 a share to basically zero. The company filed for bankruptcy. At the time, it was the largest bankruptcy in U.S. history. Thousands of employees lost their jobs. Many had their retirement savings tied up in Enron stock and lost everything. Executives were investigated and charged. Anderson, the accounting firm, collapsed as well. One company's fraud took down another. So what can we learn? Complexity can hide problems. If a business is too complicated to understand, that's a risk. Accounting isn't always reality. Profits on paper don't always mean real cash. Incentives matter. Executives were rewarded for stock price, not long-term stability. Enron didn't fail because energy markets collapsed. It failed because the numbers were never real. It was a house of cards built on accounting tricks. And when the truth came out, there was nothing holding it up. If you want more breakdowns like this, follow for the next one.